So when you see a stock hit a massive 25-year high, right?
Right.
But at the exact same time, they were reporting negative net income. I mean, is that a screaming strong buy riding this unstoppable AI wave? Or, is it just a severe value trap waiting to snare everyday retail traders?
Yeah, that is like the ultimate puzzle for the market right now
Right.
because you have these algos just blindly buying the momentum. And then the fundamental analysts are just, well, they're scratching their heads.
Totally. So welcome to today's deep dive. Today's April 21, 2026.
Hard to believe we're already here.
I know, right? And in exactly 48 hours, Intel Corporation, so ticker symbol INTC, they're going to hold what might honestly be the most anticipated earnings call of the decade.
Oh, without a doubt.
Yeah, and we have a stack of incredibly polarizing market data, analyst notes, technical readouts, I mean, all of it. Our mission today is to really dissect all this and figure out how a company losing, $500 million is somehow worth over $300 billion.
Yeah, and we're going to uncover the real geopolitical game being played behind the scenes, too.
Exactly. Quick reminder up front for you guys listening, hit that like button, subscribe to the YouTube channel, and, it's compulsory. Leave your feedback in the comments.
Yes, please do.
Because your thoughts really actively shape the deep dives we do next. And, of course, a firm disclaimer before we really get into it. This deep dive is a debate and an analysis of provided market data. It is absolutely not financial advice.
Right, no financial advice here.
We are just looking at the mechanics of the market, not telling you what to do with your portfolio.
Yeah, we're here to understand the why behind the numbers, because the numbers right now are, well, they're behaving in a way that just completely defies conventional logic.
They really are.
Yeah.
So let's look at the initial setup. As we sit here today, Intel stock is trading at $65.70.
Right.
It's down, I think, 4.09% for the session. But that red number is kind of hiding this staggering headline. Just days ago, on April 17th, this stock hit a 25-year high of 73 cents.
Which is just wild.
Right. I mean, we haven't seen price action like that since the peak of the dot-com bubble.
Yeah, and what's fascinating here is the overarching theme that's driving that peak. It isn't necessarily about what Intel is producing today.
Right.
It's about a foundational pivot in their entire business model. So Intel is aggressively transitioning toward what they call their Angstrom Era manufacturing roadmap.
The Angstrom Era, yeah.
Exactly. And they are essentially turning themselves into a global foundry.
Let's unpack that foundry pivot for a second, because I feel like a lot of people just misunderstand what Intel actually does now.
Oh, absolutely.
Historically, it's like Intel was like a world-famous chef.
Right.
But they only cooked for their own private restaurant.
Right, exactly.
They designed their own chips, and they baked them in their own state-of-the-art kitchens, like their fabrication plants or fabs.
Yeah.
But now they're changing the entire model. They are renting out those private kitchens to rival chefs. They want to manufacture chips for everyone else.
That chef metaphor is spot on. I love that. They are attempting to become basically the kitchen for the entire tech industry.
Right.
But building out those kitchens to handle external clients is incredibly capital intensive. I mean, if we look at the trailing 12 months, the TTM financials, you really see the financial toll of this transition.
Yeah, the numbers are crazy.
Intel brought in an enormous $52.85 billion in revenue.
Billion. With a B.
With a B. But when you get down to the bottom line, the latest quarter saw a net income of negative $591 million.
Wait, negative $500 million in a single quarter?
Yeah.
And the earnings per share, that's sitting in the red too, right? Between negative 6 cents and negative 8 cents?
Exactly.
The margins really tell the story of the squeeze, I think. Like, their gross margin is decent. It's sitting at 34.77%.
Which means they are making money on the actual silicon they sell.
Right, but then their operating margin is deep in the red at negative 4.19%.
Right, and this is where we have to, really look under the hood of the accounting.
Okay, lay it on me.
Because that negative net income is scaring a lot of retail investors, naturally. But institutional money is looking at something entirely different.
Well, I want to push back on that institutional side for a second, because how does a company with a negative $500 million quarter sustain a market cap of around $329.88 billion?
It sounds crazy, right?
It feels like complete cognitive dissonance to me. It's like rebuilding an airplane's engine mid-flight while bleeding cash.
It totally looks like dissonance until you separate the income statement from the cash flow statement.
Okay.
You have to understand the mechanics of depreciation in semiconductor manufacturing.
Right, depreciation, yeah.
When Intel buys, say, a next-generation EUV lithography machine from ASML.
Those are the massive machines that actually print the chips, right?
Exactly. And that machine might cost $300 million.
Wow.
So that cash living in the bank account today. But on the income statement, that $300 million is depreciated or spread out over a decade.
Oh, I see. So they are taking these colossal accounting hits on paper for equipment they've already bought.
Precisely. Which brings us to their liquidity safety net. Intel is sitting on a war chest of roughly $63.7 billion in cash and equivalents.
Almost $64 billion in cash.
Yeah. And compare that to their short-term liabilities, which are only about $31.6 billion.
Oh, wow. So they have double the cash to cover their short-term debts.
Exactly. Furthermore, their debt-to-equity ratio is sitting between 37.28% and 40.76%.
Which is pretty healthy, right?
In the capital-intensive world of fabs, yeah, that is a highly conservative leverage profile.
That actually brings up a fascinating point for the sources that we were looking at. Their free cash flow growth actually exploded by 107.35% in Q4 of 2025.
Insane metric.
This completely blew my mind when I read it. A company with negative net income managed to literally double its free cash flow.
Right, because the core operations are still generating tremendous cash, and the losses, quote unquote, are largely tied to those non-cash depreciation hits and the aggressive capital expenditure required to build out the foundry business.
So it's intentional.
Yes, they are intentionally suppressing their short-term earnings to build the infrastructure required for the 2030s.
Okay, so if the fundamentals show this very expensive, kind of muddy construction zone, the technicals show a rocket ship.
Oh, absolutely.
The chart has been on a phenomenal 52-week run. I mean, it started way down at $18.25 and ran vertically to $70.33.
It's just a massive climb.
Right. And that kind of climb isn't driven by value investors looking at, depreciation schedules. That is driven by algorithm momentum and technical trading.
Yeah, from a purely technical perspective, the long-term trend is fiercely bullish. I mean, the stock is up 78% year-to-date.
78%.
And the moving averages from the short-term 5-day all the way to the 200-day are flashing a strong buy.
Wow.
We're seeing 10 distinct buy signals across the indicators against only 2 sell signals.
But, the stock is down over 4% today, which tells me that 25-year high of $70.33 in basically acted as a brick wall.
Yeah, it hit a major psychological ceiling.
The stock tested that resistance level, failed to break out, and is now retracing.
Exactly. When a stock hits a quarter-century high, profit-taking is inevitable. The algorithms that rode it up from $18 are programmed to start unwinding their positions at key historical levels.
That makes sense.
If you look at the current order flow, the market is incredibly tight. The bid is sitting at $65.62, and the ask is at $65.79.
That razor-thin spread tells me the market is in a complete standoff right now.
Oh, totally paralyzed.
Buyers and sellers are practically just staring at each other, waiting for someone else to make the first move.
It's a standoff fueled by a clash of trading psychologies, really. The buying pressure over the last few months has been fueled by intense AI optimism.
Right.
But right now, at $65, that momentum is actively battling the gravity of the underlying valuation. Traders are looking at Thursday's impending earnings call and basically asking themselves, is the future fully priced in here?
Which perfectly sets up the debate happening on Wall Street right now. The technical algorithms are screaming strong buy, based on a 78% rally, but the fundamental analysts are looking at the negative earnings and violently hitting the brakes.
Right?
So is Intel an undervalued gem, or is it the ultimate retail trap?
Well, let's look at the official analyst consensus because it reflects that exact paralysis we just talked about.
Okay, let's hear it.
Out of the top analysts surveyed, you have exactly 9 rating it a strong buy or buy.
Nice.
You also have exactly 9 rating it a sell or strong sell.
Perfectly balanced.
And sitting right in the middle, refusing to take a side, you have 32 analysts rating it a hold.
32 holds. Wow. Nobody wants to stick their neck out on this one.
No one.
But here is the statistic from the data that really highlights the split. The average 12-month price target from these analysts is $52.26.
I mean, think about what that implies.
It implies a 20% downside from where we are trading right now.
Right.
Yet the high targets on the street are calling for $92. It's as if these analysts are looking at two entirely different companies.
They essentially are. They're evaluating two different timelines. So the analysts calling for $52, they're looking at the math of today. Based on historical price-to-earnings ratios, and especially considering the current negative EPS, the stock is broadly considered overvalued.
Or at least modestly overvalued.
Yeah. You simply cannot justify a $65 price tag on a company losing money if you only look at the present.
Right.
The analysts calling for $92, however, are completely pricing in the narrative of tomorrow.
And this is where the severe downside risk comes in for the listener, right?
Yeah.
Especially everyday retail traders.
Oh, absolutely.
Because we see this cycle repeatedly. A retail trader sees a headline about a stock hitting a 25-year high. They see a chart going up and to the right.
Yep.
And they jump in based purely on FOMO, fear of missing out.
Classic.
They completely ignore the underlying volatility. They ignore that the average analyst expects the stock to literally drop 20%, and they fall into a classic value trap. They end up buying the absolute top just as the institutional smart money starts taking profits.
Exactly. Because when a stock is priced for perfection, based entirely on future promises, any slight deviation from the timeline causes a violent correction.
So to understand why some analysts are willing to risk their reputations on a $92 price target, while others are essentially predicting a 20% crash, we have to look at the actual catalyst.
Yes, the catalysts are key.
What is the best case recovery scenario driving this greed versus the worst case continuation lower? Let's start with the bull case.
Okay, so the bull case is built on a series of structural, industry-shaking partnerships, and the absolute crown jewel of this is the Terafab deal.
Oh, man. This is the massive partnership with Elon Musk, right?
Yes.
Encompassing Tesla, SpaceX, and his artificial intelligence venture, XAI. Intel is slated to produce advanced AI chips for Musk's companies using their brand new 18A process node.
We really need to explain what that 18A node actually means because it is the linchpin of Intel's entire strategy.
Okay, break it down.
The A stands for Angstrom.
Right, and an angstrom is a metric unit of length equal to 1/10,000,000th of a meter. It's unfathomably small.
Unfathomably. For decades, the semiconductor industry measured transistor gates in nanometers like 10 nanometer, 7 nanometer, 5 nanometer.
Right, we've all heard of the 5-nanometer chips.
But we have shrunk these transistors so much that we literally ran out of nanometers.
Wow.
Yeah. So 18A refers to 1.8 nanometers. At this scale, Intel's engineers are essentially arranging individual atoms to control the flow of electricity.
That is basically magic.
It is a profound technological leap. If they pull it off, it puts them ahead of their main rival in Taiwan.
And that actually brings up a crucial why for the listeners.
Right.
Why does Elon Musk, who has his pick of any manufacturer on Earth, want to partner with Intel for 18A?
Well, it really comes down to geopolitics.
Okay.
Right now, TSMC, the Taiwan semiconductor manufacturing company, has an absolute monopoly on the world's most advanced chips. Every tech giant relies on them.
And that creates an unacceptable single point of failure, right?
Exactly.
If there is a geopolitical crisis in the South China Sea or, a blockade of Taiwan, the global supply of advanced silicon halts overnight. So Musk needs a geographic hedge. He desperately needs advanced chips fabricated on North American soil.
Which leads right into the next major catalyst. Intel also has an expanded deal with Google Cloud to co-develop custom AI CPUs.
Huge.
Yeah. And beyond the tech giants, you have the United States government stepping in as a foundational backer. Intel secured $11.1 billion in CHIPS Act funds, which has actually been converted to equity.
Wait. That CHIPS Act funding is not a standard subsidy then?
No, not at all.
Exactly. This is the aha moment of the entire deep dive, I think. When the U.S. government converts $11.1 billion into equity, Intel ceases to be just a consumer electronics company.
Right.
They become a literal proxy for American national security.
Absolutely.
The Pentagon requires advanced semiconductors to guide missiles, run defense networks, and power military AI. They cannot rely entirely on supply chains stretched across the Pacific Ocean.
It's too risky.
Right. So by backing Intel, the U.S. government is effectively declaring that Intel is too strategically important to fail.
Yeah, it makes for an incredibly compelling narrative. You have Elon Musk, Google, and the Department of Defense all heavily pushing Intel to succeed.
It's quite the lineup.
But every single piece of that $92 bull case is built on a highly fragile foundation. And that brings us to the bear case, the $52 reality.
All right, let's walk through those downside risks. What's the catch?
The absolute biggest risk here is execution. specifically manufacturing execution.
Okay.
The Terafab deal, the Google deal, the DoD backing, they all rely entirely on Intel successfully ramping up that microscopic 18A process by late 2025.
And working at the atomic level is obviously prone to devastating errors.
Oh, yeah. We call those yield issues. In semiconductor manufacturing, you take a 300-millimeter silicon wafer and etch hundreds of identical chips onto it.
Right.
If the manufacturing process is perfectly dialed in, you might get an 80% to 90% yield, meaning 90% of those chips work perfectly.
But if the 18A process is finicky.
Right. If the process is unstable, a single misplaced atom or a microscopic speck of dust ruins the entire chip. If the yield drops to 30% or 40%, the cost to produce a single working chip just skyrockets.
Yeah.
And Intel has a history of delaying new nodes.
They do.
So if there is a yield issue with 18A and the timeline slips into 2026, the entire bull thesis collapses.
Because Musk and Google are not going to wait around if Intel cannot actually deliver the volume of silicon they promised.
Exactly.
They will just go back to TSMC.
Furthermore, there is the undeniable reality of the AI lag.
Right, the AI lag.
Intel is making aggressive moves, sure, but in the current AI GPU market, the processors actually training these massive large language models, Intel is perceived as a surprisingly small player compared to heavyweights like NVIDIA and AMD.
So they are trying to catch up in a race where the leaders are already sprinting miles ahead.
Exactly. And playing catch-up requires an exorbitant amount of cash.
Which brings us to the final bear point, right? Margin pressure.
Yes.
We talked about the $63 billion cash pile, but the capital expenditure required to build these new foundries in Ohio and Arizona is astronomical.
It's what?
They are building some of the most complex factories in human history.
That CapEx is going to continue applying severe downward pressure on their profitability. I mean, you can only sustain negative net income for so long before Wall Street simply loses patience.
So if we synthesize these two scenarios, the divergence is incredibly stark for you listening at home.
Really stark.
The best-case scenario is basically a masterclass in turnaround execution. Intel perfects the 18A ramp-up without delays. They become the premier, geopolitically secure foundry alternative to TSMC.
Right.
They capture market share from Musk and Google. The gross margins expand. The U.S. government gets its domestic supply chain, and the stock runs to $92.
And the worst-case scenario? The physics of the 18A node prove too difficult to scale.
The atoms don't cooperate.
Right. The timeline slips by 6 months. The immense capital expenditures drain their cash reserves much faster than expected.
Oh, wow.
The major partners lose faith and look elsewhere. And the stock price, having completely lost its narrative momentum, cascades back down toward the average analyst target of $52.
Or even lower, right back into its 52-week range.
Yep.
It is engineering precision applied to financial chaos. So what does this all mean for you, the listener, heading into this week?
Great question.
In the long term, everything hinges on Intel's ability to execute on the factory floor. It is a story of heavy industrial competence, not just artificial intelligence hype.
And in the short term, heading into Thursday.
Well, in the short term, you should expect intense, unpredictable volatility. The next 48 hours leading up to that April 23 earnings call are going to be a complete roller coaster.
Oh, strap in.
The options market is currently pricing in a massive swing in one direction or the other.
Because the market hates uncertainty. And right now, Intel is, without a doubt, the most uncertain stock on the board.
Absolutely. Well, thank you so much for joining us for this deep dive. Before you go, hit that like button, subscribe to the channel, and jump into the comments.
Yes, let us know what you think.
Let us know. Are you buying the Intel national security bull case, or are you staying far away from what looks like a classic retail value trap? We genuinely read every single comment.
And as you weigh the fundamentals against the technicals, I want to leave you with one final, slightly unsettling thought to ponder ahead of Thursday's earnings call.
Oh boy, here we go.
With a negative earnings per share and the stock's massive 78% year-to-date rally built almost entirely on the promise of Elon Musk partnerships and the future 18A chip.
Right.
If Intel reveals even a one-quarter delay in their foundry timeline this week, does this entire 25-year high narrative unravel in an instant?